Chapter 10 has a few different things. Actually, these are very difficult topics, but hey, that's what we're here for. Deferred taxes and then pensions. And we'll go ahead and get started on here. Okay, deferred taxes. Deferred taxes come about because of a timing difference between the IRS and the accounting principles. So the accounting principles may say to recognize something in this year, and the IRS may have a different idea on that. And we'll talk about those in a second. So, timing differences. I should have underlined that too. And I promise we'll get on with it. Okay, so timing difference between accounting principles and IRS rules. Okay, so let's take a look here and see what I'm talking about. All right, revenues. So money coming in. If the IRS recognizes it earlier than GAAP, we have a deferred tax asset. And what that would look like is rent, something like the rent paid in advance. So unearned rent. Okay, so if someone pays me rent in advance, so they're going to rent the place, I say I need 3 months rent up front, you know, for security deposit and all that kind of stuff. You know, they pay me in advance. Now I haven't earned that money. So for accounting rules, I don't count it because I haven't earned it yet. IRS says, oh no, you got the cash, you can pay the taxes. So even though I can't recognize it for GAAP rules, for accounting rules, the IRS is going to say you got the money, you can pay the taxes on it, so it's paid. Now the second one here is going to be just the opposite. Say as someone who's renting the place, and I say, okay, I'll tell you what, you can take 3 months to pay me the rent. So whatever it is, let's say October, November, December, you can pay me that in January. Okay, so I count it as revenue for GAAP, but I haven't got the cash yet. The IRS says, well, if you don't have the cash, you can't pay the taxes on it. So even though I count it as revenue because I've earned it, that's the kind of first two ones here. That's what we're talking about. So they look at a lot of times. They look at the IRS will look at the cash. You know, do you have the cash or not? If you have the cash, you can pay the taxes. If you don't have the cash, you can't. And expenses are kind of a little bit different in that they will reduce your taxes. And for taxes, you like expenses. You love them. And if the IRS recognizes it earlier, that means that we can reduce how much we pay in taxes. Okay, and a common one for that is depreciation, which we're going to do down here at the bottom. It's very common to have because of the depreciation. It's hard to find a business that doesn't have some kind of an asset, whether it's computers or phones or desks or chairs or whatever. And any of those things that are depreciated, the IRS is very generous in allowing you to depreciate a lot of it very early, which you like. Sometimes you can depreciate 100% of it in the first year. The reason you like that is that it reduces your taxes immediately. And by the way, why does the IRS do that? Because they love you, and they're not, no, they're doing it because they want people to encourage people to keep the economy going by buying assets. And not only that, if people buy assets, they keep the business going, it keeps people employed, they tax the people, it really leads to a lot of good things for the economy and for, so that's why the IRS is very generous in allowing you to depreciate equipment and stuff. And it's not because they think it depreciates that much quicker or anything like that. Or that actually is your true income. They're trying to encourage you to do those things. Okay, expenses that are recognized later by the IRS. If you sell something and it comes with a warranty, right when you sell it, let's say it has a 3-year warranty, you have to expense the estimated cost of that warranty over 3 years. The IRS says, oh, no, you can't do that because you haven't paid it yet. When you pay those warranty costs, then you can write them off, but not until you pay them, again, following the cash. And the IRS is not like you estimating expenses. So they say, oh, no, cash is what we're going to look at. So warranty expenses. All right. So coming down here to our problem, you'll notice that the operating expenses allowed, let's see here, are different between our income statement and our income tax return. So this is GAAP. And this is the IRS. So we're in this situation here, which is again, a very common scenario. And you'll notice something here. So this provision for income taxes, this is the same as income tax expense. On our income statement form here, we got that as $900 for every year. Okay, same income and all that. Down here, you'll notice that it's different. For one thing, the taxable incomes are different, compared to our regular income up here. So these are both different for the income taxes payable and the expense and so forth. Now, if you were to add all these up, and I'll do it right now. In total for these 4 years, it's the same. So what we're really talking about here are timing differences. You notice that the expenses they allow are $9,000 the first year, which we like, $8,000, but at some period of time, for example, if you're depreciating something that costs whatever $10,000, there's only so much you can only depreciate up to $10,000. After that, you can't. So the IRS will run out of stuff to So you might be depreciating over 10 years at $10,000, but the IRS allows you to do it in 3 years. Okay, but eventually the cost of it runs out, the depreciable amount. Okay, so we have this difference in provision for income taxes. This is a tax expense, and these taxes payable. So there's a difference there. So let's see what the difference is. Let's see here. I'm going to bold that whole thing. I'm going to bold it. I'm going to make it just kind of dark red. Okay, so I'm going to take the provision for income tax, the tax expense, minus. Okay, so here's the difference for the first year. So this is going to be a deferred tax liability. Year one, we owe $500. So in the future, we're going to have to pay that off. And you'll notice the taxes payable here, they climb, right? 400 the first year, 650 second year. Okay, so let's go to year two. Now, year 2 is a little bit tricky because we have not paid off that 500. So year 2 will be that plus that. For year 3, you'll notice that things start to change. Our tax expense is 900 and our taxes payable is 1,200. So we actually have to pay $300 more than our tax expense. So we're starting to pay this down. So this will be you can just copy that over. And coming over here, 450 extra we have to pay in over our expense. And so you know that this wipes itself out after for whatever period of time the item is depreciated over. So it's sort of like a long-term liability. This deferred liability is sort of like a long-term liability that eventually you pay off. Now, in business, because businesses buy equipment and so forth year after year after year, a lot of times they carry this liability on the books, and it looks like it's never getting paid, but actually it's getting paid off. It's just getting and a new one's being opened up. You buy a new piece of equipment, okay, you get a new long-term liability. But remember, even though it's long-term liability, it's almost like cash that's been saved by being paid to you early. So it isn't like, oh, they're going to charge me more money. It's actually they're giving you more money up front because they want you to buy more equipment. Again, that's a very common thing. Okay, so that is that one. Okay, let's go to page column 2, deferred taxes. Hey, more deferred taxes. Reporting deferred taxes. Okay. So the current taxes are going to be payable. And by the way, one thing generally if something is you say, are there current deferred taxes? Generally not, because deferred taxes mean that they're not going to get paid. If they're current, that means you're going to get paid in the new year. So current taxes are payable because you're going to get paid within 1 year. So deferred taxes are generally the long-term kind of thing. So going back to our problem. Okay, so net current taxes payable at year end. So this is going to be the payable. And down here, oh, this one's actually a little bit interesting. I'm going to do something here. Okay, so this is going to be the payable. And let's put a box around it. And I'm going to just make a note here about something. So this is a deferred tax. Oops. Deferred tax liability. This one is actually going to be a deferred tax asset. This is money that we paid ahead of time. Whatever it is, I don't know, That would be a tax account for a foreign one, but we always net these. So these are going to be net. These are the net amounts. So we have a deferred tax liability of 3,000. We have a deferred tax asset of 500. So the net will be 2,500. Okay. So Tax expense will be the entire amount. They do it. There's something wrong here. And this will be actually, I say income taxes payable. There could be other kinds of taxes. So income taxes payable would look like that. Deferred to a future period would be again, this is the net amount, and that would be, I did this wrong. Scratch that. Paid currently is this. So this would be the provision for taxes or income tax expense. I see what I did. I jumped around. Paid currently would be the 8,000, and then down here we owe the 2,500. I'm going to back out a little bit here so we can kind of see it. So we're going to write a check for 8,000. Now in the future, we're going to have to pay off this 2,500, but not yet. Okay. And again, you do often see this called provision for income taxes. You also see sometimes called income tax expense. They're interchangeable. Okay. Now for something completely wacky. Okay, the pension we're going to look at here is what's called a defined benefits pension. There's basically two different kinds of pensions. The one pension is the one that most people have nowadays. That's like a 401k. You work at the job and you put a certain amount of money in there, and those you can choose what accounts those go into, and the money grows. And when you retire, that's what you live off of. There's a second one called the defined benefit one, which is the one that's a real problem. And it's a real problem because it's you're telling the people who are the people who are the pensioners when they start retire and they start taking their pension that you're going to pay them a certain amount for the rest of their life usually. So okay, we're going to pay you whatever 60% of your last salary for the rest of your life, and there could also be health benefits and all kinds of stuff like that. The problem is, by the way, and these defined benefit pensions are the ones that are really bankrupting Illinois, Chicago, the state governments, because they promised all these things to the people, and now they're, you know, as in the future, there was no money set aside for those while we were going on. So those are unfunded, basically. A lot of those are unfunded, and they can be huge amounts. And back when they were given, a lot of times, you know, back in the 1960s, you know, the average life expectancy was whatever, 67 years. So when people retired, you know, you plan, okay, on average, you're going to live a couple of years. Sometimes they might live in their 80s, you know, but, you know, we're talking about a short period of time. Nowadays, you have people retired at 65 and they live 95. You know, instead of 3 or 4 years, these pensions are for 30. You know, and healthcare back then was not that big of a deal. So you have these healthcare costs that are just enormous. Hundreds of thousands a year. Even. So, you know, these defined benefit programs are a real problem, and for companies too. And these pension funds can be larger than the companies themselves. When I worked at Navistar, we had 11,000 employees, and we had 39,000 retirees. We had over 3 times as many people retired as people working. So, you know, whatever those 11,000 people do, it also has to pay for, you know, 3 times, you know, 3 more people, basically. So, you know, a lot of these companies, these pensions are huge. Now, the way it's organized is the pension is separate from the company. The company will give money to the pension, but the pension itself is separate from the company. So that's what we're going to go through here. So here's General Motors, and General Motors will make cash payments into the pension fund. The pension fund will have assets, cash and investments and all kinds of stuff, you know, try to make more money for the fund. And over here, on this other side, we have the liabilities. The liabilities are owed to pensioners. So these are, you know, these people retire and they're owed a certain amount of money, you know, to be paid out to them. The cash gets paid out of the assets. We pay it to the pensioners. As we pay them, this goes down. And over here, we project how long you're going to live and all that kind of stuff. And it's paid to the pensioners. And as it's paid, pensions go down. Now, as more people retire, this goes up. As this earns money, it goes up. Or if it loses money, it goes down, and blah, blah, blah. So anyway, but basically it is this. General Motors gives cash. The cash is invested and it's paid out to the pensioners. So it's completely separate from the company. And again, these plan assets may be bigger than GM. When I worked at Navistar, ours were. Okay, so we want to see, I think what we're going to look for is whether these are underfunded or not. Okay. So here's the plan assets. So for 2021, we had 139, these in thousands or millions? Oh, yeah, look at this. These are in millions. So this is 139 billion. It's staggering. 139 billion in a liability. But that's what it is. Okay, so 139 billion. Now notice that from one year to the next, the ending in 2021 will be liability over here. And luckily, I've made my little arrows so that I can simply, I gotta adjust them a little bit. So, the ending for this year becomes the beginning for the next year. And the return, it looks like they lost money on it. The employer put in another 3.6 billion, paid out 7.2 billion. blah, 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 big numbers. Okay. And the defined benefits, now this is sitting over here, we have this liability. So it was liability 164,000. So here's 164,000. And we have service costs, we have interest costs, blah, 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 going down here. And so this is, and by the way, interest costs, the one thing about the pension liability is just like any other liability, that a long-term liability, that there's usually interest involved. So there's interest involved on that pension liability. And it can be different than the interest earned on the assets. Okay, so here's what we're going to do. We're going to see if this thing is underfunded or not. Okay, so 2021, we have planned assets of bold these. 139, we had liabilities. It says put these in as negatives. And so this is underfunded. Actually, I should probably change the way that I show that. Okay. By that. And we do the same thing for okay, so we had 129 billion in assets, 146 billion in liabilities. So this is the over under funding. Yeah. Sorry. Let's try it again. Okay. So these are underfunded by, oh, how would the debt position be reflected on the balance sheet? This would be a long-term liability. It's got liability or obligation. So it could be long-term pension liability or pension obligation, same thing. These different terms for them. So long-term liability, and these are in billions. So 25 billion in 2021, 16 billion in 2022. Okay. Down here, this is the discount rate. This is for the liabilities. This is going to be for the projected benefit obligation. I'm going to copy it. Nope. And this is for the plan assets. And we'll make them the same. So we're discounting this liability at 5.2% and at 4.5% in 2022. 2021, we thought that the return on the assets, the assumed rate would be 5.55%. And in 2022, 6.3. Yeah, so these would be the rates that we'd use for both of these. So we think that the liabilities are going to go up by an interest rate of 4.5. We think that the return on these assets is going to be 6.30. And the return on these assets will help pay off, the liability. Okay, now, I like these two. Oops. Well, something we can see. How about that? All right, changing rates. When the rates change, it can cause the amounts to change. So, if the, for instance, if let's say the planned assets, that's the easiest one. If the amount of return you're making on your planned assets, if it goes up, obviously that's going to change the assets, right? They'll be worth more, projected to be worth more than if the interest rate, if the rate of return you had on the assets went down. And it's just the opposite for the liabilities. So I'll talk about that down here. Oops. Oh, geez, I almost closed the meeting. Let's not do that. Still learning how to use these computers. Okay, so coming down here, so changing rates. All right. So present values, these are the pension ones, or we're discounting them back to today. An increase in the change rate will decrease the total value. So if the pensions, if the rate that the liabilities is, if it increases, it will actually decrease the future value. And just the opposite for if the rate change decreases. Plan assets, these are a little more obvious. Plan assets. If your rate of return on your assets increases, well, the value is going to increase. If the rate of return on your assets decreases, well, the value is going to decrease. And so that's what we got down here. So lowering the discount rate. So decreasing the discount rate will increase. It's nice, will increase. By the way, the obligation you all have, and just people who are used to working with these will, let's call it the PBO. Raising the expected rate of return from 5.5% to 6.30 will increase or decrease the expected return. Will increase the expected return. there's a lot there. And by the way, I should probably mention a couple things about this before we go too much further. And that is that pensions, the actual figuring out the pension, the projected benefit obligation, and even the return on assets and stuff like that, those are usually done by professionals. The actuaries will actually do the projected benefit obligation. These are people that they have to look at life expectancy and the payouts and then, the insurance and all that kind of stuff. So look at all that, the level of people are going to retire and all that. It's very mathematical. There actually is an exam for it. There's 10 exams to become an actuary, math exams. But anyway, those are done by somebody else, and they, as accounting people, they hand that to us basically. They say, "Here it is," and that's. So those are not calculations that we actually do, but we have to know how to account for them. So that's kind of what we're getting at here. And again, for some companies, these are absolutely huge. I don't know what kind of assets they have at General Motors, but to have 130 billion in assets in their pension is quite amazing. Let me back up on this. Okay. Well, I will see you guys for chapter 11.